studying your last two. I swim med tea when they turned in. The staring down to mute. And can learn the pole that sunk he died.
At this point, we've learned about the different investment income schedules and how they interact within a corporate tax return. Now it's time to focus on the most important schedule in the entire investment income reporting process, Schedule 7. If you understand Schedule 7, you understand the heart of corporate investment income taxation. Think of Schedule 7 as the control center of the T2 return. Just like a mission control room receives information from many sources, analyzes it, and directs decisions, Schedule 7 receives information from multiple schedules and uses it to drive critical tax calculations. Let's start with the inputs on the left side of the slide. The first source of information comes from Schedule 6. Whenever a corporation realizes a capital gain, Schedule 6 calculates the taxable portion of that gain. That taxable capital gain is then sent into Schedule 7. The second source is Schedule 3. Schedule 3 handles dividend reporting and Part 4 tax calculations. Relevant dividend information is passed into Schedule 7 to support the overall investment income reporting process. The third source comes directly from the corporation's financial statements. This includes items such as interest income, rental income, foreign income, and other forms of investment income. All of these sources flow into Schedule 7. Now look at the center of the slide. This is where the real work happens. Schedule 7 collects all investment income information and combines it into one place. It calculates aggregate investment income, commonly called II. It calculates adjusted aggregate investment income, or AAII. It evaluates whether passive income may affect the corporation's small business deduction. And it helps track information that feeds into refundable tax calculations. This is why Schedule 7 is often called the investment income hub. It doesn't simply store information. It processes information and transforms it into meaningful tax calculations. Now let's look at the outputs on the right side of the slide. Once Schedule 7 completes its calculations, the results are sent to several important destinations. First, the information flows into the T2 corporate tax return itself. Second, it supports the overall corporate tax calculation. And third, it helps determine the impact of investment income on small business deduction eligibility. This is a critical point. Schedule 7 influences not only how investment income is taxed, but also whether the corporation continues to qualify for valuable small business tax benefits. At the bottom of the slide, you'll see the complete story summarized in one simple flow. Investment income enters the corporation. Information flows into Schedule 7 from multiple sources. Schedule 7 processes and calculates the results. Those results then flow into the T2 return, tax calculations, and small business deduction analysis. The key takeaway from this slide is simple. Schedule 7 sits at the center of the investment income system. It receives information, it performs calculations, and it distributes the results throughout the T2 return. Without Schedule 7, investment income reporting simply would not work. That is why every corporate tax preparer must understand it thoroughly before moving on to more advanced T2 calculations. Now that we've seen how Schedule 7 sits at the center of the investment income reporting system, let's look inside and understand what Schedule 7 actually does. Many new tax preparers think Schedule 7 is simply a place to report investment income. In reality, Schedule 7 is one of the most important calculation engines in the entire T2 return. Its job is to receive investment income information, process that information, and produce results that directly affect corporate tax calculations and small business deduction eligibility. Let's start on the left side of the slide. Schedule 7 receives several different types of investment income. This includes interest income from bank accounts, bonds, and GICs, rental income from real estate and other leased assets, foreign income earned outside Canada, and taxable capital gains that are calculated in Schedule 6. All of these amounts flow into Schedule 7 for analysis and calculation. The first major calculation performed inside Schedule 7 is aggregate investment income, commonly known as AII. Think of II as the total amount of passive investment income earned by the corporation. Schedule 7 combines interest income, rental income, foreign income, and taxable capital gains to determine this amount. This is the first major output of the schedule. Next, Schedule 7 calculates adjusted aggregate investment income, or AAII. AII is one of the most important numbers in corporate tax planning. While AII measures investment income, AII is the amount used to determine whether a corporation's small business deduction limit may be reduced. This is why tax professionals closely monitor AII every year. After calculating AII, Schedule 7 performs the next critical function. It evaluates the impact on the small business deduction, often referred to as the SBD. Notice the threshold chart at the bottom of the slide. If AAI is $50,000 or less, the corporation remains in the green zone. There is no reduction to the small business deduction, and the corporation retains full access to the small business limit. As AAII increases above $50,000, the corporation enters the yellow zone. In this range, the small business deduction begins to be reduced gradually. The more passive income the corporation earns, the smaller the available small business limit becomes. And once AII exceeds $150,000, the corporation enters the red zone. At that point, the small business deduction is completely eliminated. This is why passive investment income can have such a significant impact on a corporation's overall tax position. Now look at the outputs on the right side of the slide. Once Schedule 7 completes its calculations, it produces several important results. It determines the corporation's aggregate investment income. It calculates adjusted aggregate investment income. It identifies the small business deduction impact, and it provides information that flows directly into the T2 return and the overall corporate tax calculation. Some of these results also influence refundable tax balances and future tax planning decisions. The key takeaway from this slide is simple. Schedule 7 is not merely a reporting schedule. It is the engine that converts raw investment income into meaningful tax calculations. It determines how much passive income exists. It determines whether small business deduction benefits are preserved or reduced. And it provides critical information used throughout the corporate tax return. Understanding Schedule 7 means understanding how investment income affects the entire corporate tax system. Now let's bring everything together with a practical Schedule 7 example. The purpose of this example is to show how investment income moves through the tax system and how Schedule 7 ultimately determines whether the corporation's small business deduction is affected. Let's begin with the corporation's investment income for the year. In this example, the corporation earns $40,000 of interest income, realizes a $20,000 capital gain, and receives $10,000 of Canadian dividends. As always, the process starts by identifying the type of income and routing it to the correct schedules. Let's look at the capital gain first. The $20,000 capital gain is reported in Schedule 6. Because only 50% of a capital gain is taxable for tax purposes, Schedule 6 calculates a taxable capital gain of $10,000. That taxable amount is then transferred into Schedule 7. Next, we look at the Canadian dividends. The $10,000 of dividends received from another Canadian corporation is reported in Schedule 3. Schedule 3 calculates the applicable Part 4 tax, which in this example is approximately $3,833. The dividend information then becomes part of the overall corporate tax reporting process. Now we arrive at Schedule 7, the Investment Income Hub. Schedule 7 combines all of the relevant investment income information. In our example, the corporation has $40,000 of interest income and $10,000 of taxable capital gains flowing in from Schedule 6. Together, these amounts produce aggregate investment income, or AII, of $50,000. At this stage, Schedule 7 performs one of its most important functions. It evaluates the corporation's adjusted aggregate investment income, or AII, and compares it against the small business deduction thresholds. Notice the threshold review section in the middle of the slide. The corporation's AII is $50,000. This is an important number because $50,000 represents the starting point where passive investment income begins to affect the small business deduction. Since the corporation is exactly at the threshold, it remains in the green zone. There is no reduction to the small business deduction. The corporation continues to have full access to the small business limit. Next, Schedule 7 determines the overall tax consequences. The investment income calculations are completed. The small business deduction analysis is completed, and the resulting information is sent into the T2 corporate tax return. At this point, all of the calculations flow into the final return and become part of the corporation's overall tax position. Now take a look at the common mistakes section on the right side of the slide. Many preparers overlook Schedule 7 entirely and assume it has little impact. Others forget to include taxable capital gains from Schedule 6. Some fail to include rental income or other passive income sources. And many neglect to review the AII thresholds that directly affect small business deduction eligibility. These mistakes can create significant tax planning issues and unexpected tax costs. At the bottom of the slide, you'll see the mental model that experienced tax preparers follow. Start by identifying investment income. Route the information to the correct schedules. Process everything through Schedule 7. Determine the tax consequences. And finally, allow the results to flow into the T2 return. The key takeaway from this example is simple. Schedule 7 does far more than report investment income. It connects investment income to corporate tax outcomes. It calculates AII and AAII. It determines whether passive income affects the small business deduction. And it ensures that the correct results ultimately appear in the T2 return. Understanding this flow is one of the most important skills in corporate tax preparation.